Hello students, this is Viii and we are going to learn about how to calculate profitability ratio. Students, first of all, we will discuss the term profitability ratio. Profit is the reward for every business. Therefore, profitability ratio are essential to know the earning capacity of a business concern. These ratios are classified as a general profitability ratio, 1 gross profit ratio, 2 operating ratio, 3 operating profit ratio, 4 expense ratio, 5 net profit ratio. B overall profitability ratio, 1 return or net worth ratio, 2 return on equity capital, 3 return on capital employed, 5 4 earning per share, 5 dividend payout ratio, 6 dividend yield ratio, 7 price earning ratio, 8 return on total asset oblique resource. A general profitability ratio, 1 gross profit ratio. It established the relationship between gross profit and net sales of business. Gross profit ratio is equal to gross profit divided by net sales into 100. This ratio is measure of general profitability of a business. A low gross profit reflects unfavorable purchase and make up policies inability of management to increase sales volume. A high ratio without any increase in cost is favorable to business because it increases sale volume. 2. Operating ratio. This ratio is also called as operating cost ratio. It indicates the relationship between operating cost and sales. Operating ratio is equal to operating cost divided by net sales into 100. Operating cost is equal to cost of goods sold plus office oblique administrative expenses plus selling and distribution expenses plus finance expenses. This ratio measures operational or working efficiency of a business. This ratio determines the cost structure of business. Operating profit ratio. This ratio relates to operating profit and sales of a business concern. It is expressed as operating profit ratio is equal to operating profit divided by net sales into 100 or 100 minus operating cost. In this case, none operating expenses and income are ignored. This ratio shows the amount available after incurred cost on operational activities of a business. 4. Expenses ratio. There are mainly administrative expenses, office expenses, selling and distribution expenses. The expenses ratio are always called as supporting ratios to operating cost ratio. These ratio can be calculated as under administrative expenses ratio is equal to administrative expenses divided by net sales into 100. Selling and distribution expenses ratio is equal to selling and distribution expenses divided by net sales into 100. C. Finance expenses ratio. Finance expenses ratio divided by net sales into 100. D. Non-operating expenses ratio. Non-operating expenses divided by net sales into 100. Non-operating expenses include interest, dividends, etc. This ratio signifies the share of particular expenses in total cost. It further indicates how much amount incurred on a particular expenses. It helps in reducing cost. 5. Net profit ratio. This ratio is similarly calculated as gross profit ratio. It shows the relationship between net profit to sales. Net profit sale ratio is equal to net profit divided by net sales into 100. A high ratio signifies a better operational efficiency and vice versa. The net profit ratio indicates operational efficiency or inefficiency of business. Profit and loss account. Debit and credit particular To opening stock 1,25,000. To purchase 5,25,000. To gross profit old 3,25,000. Asset side by sales 9 lakh, by closing stock 75,000. Total 9,75,000 and 9,75,000. Again to administrative expenses 1,50,000. To selling and distribution expenses 50,000. To finance expenses 10,000. Net profit 1,75,000. By gross profit old 3,25,000. By other income 25,000. Total, both of total 3,50,000, 3,50,000. Calculate gross profit ratio. 2. Operating ratio. 3. Operating profit ratio. 4. Net profit ratio. 5. Administrative expenses ratio. 6. Selling and distribution expenses ratio. Solution 1. Gross profit ratio is equal to gross profit divided by net sales into 100 is equal to 3,25,000 divided by 9,000 into 100 is equal to 36.11%. Second, operating ratio. Opening cost is equal to cost of goods sold plus administrative expenses plus sales and distribution expenses is equal to 9 lakh minus 3,25,000 plus 1,15,000 plus 50,000 is equal to rupees 7,40,000. Operating ratio is equal to operating cost divided by net sales into 100 is equal to 7,40,000 divided by 9 lakh into 100 is equal to 82.22%. 3. Operating profit ratio is equal to 100 minus operating cost ratio is equal to 100 minus 82.22 is equal to 70.78%. 4. Net profit ratio. Net profit divided by net sales into 100 is equal to 1,75,000 divided by 9 lakh into 100 is equal to 19.44%. 5. Administrative expenses ratio is equal to administrative expenses ratio divided by net sales into 100. 1,50,000 divided by 9 lakh into 100 is equal to 12.78%. 5. 6. Selling and distribution expenses ratio. Selling and distribution expense divided by net sales into 100. 50,000 divided by 9 lakh into 100 is equal to 5.56%. B. Overall profitability ratios. These ratios measures overall efficiency of the business. Return on investment or net worth ratio. The ratio is also called as net worth ratio or return on shareholders fund ratio. It expresses relationship between earnings, net profit after tax and interest, and shareholder funds. Return on investment or net worth ratio is equal to net profit after tax and interest divided by shareholder fund. The trend of minimum or maximum return on investment in businesses organization. 2. Return on equity capital. Equity means owner's capital of a company. They have the right to get dividend after paying tax, interest and dividend to preference shareholder. Return on equity capital is equal to net profit after tax minus preference dividend divided by paid up equity share capital into 100. This ratio helps to investor in choosing company for getting more returns. High return on equity attract more investment. 3. Return on capital employed. This ratio expresses relationship between actual profit earned and capital employed in the business. Capital employed means the total investment in the business. There are two types of capital employed and can be calculated as follows. 1. Gross capital employed is equal to, it means total assets used in the business. Gross capital employed is equal to fixed asset plus current asset. Second, net capital employed is equal to, it refers to the sum of fixed assets and working capital. Net capital employed is equal to fixed asset plus working capital, or fixed asset plus current asset minus current liabilities. 3. Average capital employed is equal to, it refers to the sum of beginning and at the end capital employed, which is divided by 2. Average capital employed is equal to opening capital plus closing capital divided by 2. You have to know about this formula of capital employed. Capital employed is equal to total liabilities minus accumulated loss plus intangible asset plus non-business investment plus ideal asset plus fictitious assets plus increase or replacement cost of asset, or capital employed is equal to earning per share capital plus preference share capital plus reserve and surplus plus long-term borrowings minus investments outside business. The standard return on capital employed is about 15% and equal or above the standard ratio indicates higher productivity of the capital employed and vice versa. This ratio is expressed as return on capital employed is equal to net profit before tax and interest divided by capital employed. 4. Earning per share. Thus, this ratio is important to understand the earnings per equity share. This ratio has relationship between adjusted net profit and number of equity share. Earning per share is equal to net profit available for equity shareholder divided by number of equity share. This ratio shows the earnings capacity of the company whether it is improved or not. This ratio helps at the time of comparison between two companies. 5. Dividend payout ratio. This ratio establishes an relationship between dividend per equity share and earning per share. Dividend payout ratio, dividend per share divided by earning per share. This ratio indicates actual earnings of equity shareholder by way of dividend. 6. Price earning ratio. This ratio helps the investors at the time of investment in share of a company. It is calculated as under. Price earnings ratio is equal to market price per share divided by earning per share. A high ratio is a sign of appreciation in the value of share and vice versa. 7. Return on total asset / resources. This ratio is calculated as under. Return on total asset is equal to net profit divided by total asset into 100. This ratio helps in assessing the efficiency of the operational activities of business. Student, you must know about leverage ratio, so let's learn about it. Leverage ratio. Financial leverage or leverage on equity. Operating leverage, combined leverage. Earning before interest and tax divided by earning before interest and tax minus interest and preference dividend. Operating leverage, contribution divided by earning before interest and tax. Combined leverage means financial leverage X divided by operating leverage. EBIT means earning before interest and tax. 8. Dividend yield ratio. This ratio is calculated as follows. Dividend yield ratio is equal to dividend per share divided by market value per share. This ratio helps to make comparison of dividend per share and its effect on market value per share. Now we will understand in detail by taking into consider the following example. Problem. From the following trading and profit and loss account and balance sheet as on 31st March 2020, calculate given ratio. Trading and profit and loss account for the year 31st March 2021. Particular. Debit and credit side. Particular. To opening stock 60,000. To purchase cash 30,000. Credit 1,60,000. 1,90,000 outer. To gross profit carried down 90,000. Buy sales cash 60,000. Credit 2,40,000. Buy closing stock 3 lakh and by closing stock 40,000. Total debit side total 3,40,000. Credit side total 3,40,000. To sundry expenses 20,000. To depreciation to fixed asset 10,000. To income tax 50,000. To net profit 45,000. By gross profit older 90,000. Total 90,000. Balance sheet as on 31st March 2008. Liabilities. Share capital 1,50,000. Reserve fund 30,000. Profit and loss account 55,000. Sundry creditors 40,000. Bills payable 10,000. Fixed asset 85,000. Investment 50,000. Closing stock 40,000. Sundry debtors 80,000. Cash at bank 30,000. Both of total 2,85,000. 2,85,000. Calculate current ratio, quick ratio, 3 stock turnover ratio, 4 debtor turnover ratio, 5 credit turnover ratio, 6 gross profit ratio, 7 net profit ratio, 8 fixed asset to net worth, 9 average collection period, and 10 average payment period. Solution. Current ratio is equal to current asset divided by current liabilities. Means 40 is equal to 40,000 plus 80,000 plus 30,000 divided by 40,000 plus 10,000 is equal to 1,50,000 divided by 50,000 is equal to 310 to 1. Second, quick ratio. Quick asset divided by current liabilities means is equal to current asset minus stock divided by closing current liabilities is equal to 1,50,000 minus 40,000 divided by 50,000 is equal to 1,10,000 divided by 50,000 is equal to 2.2 10 to 1. 3. Stock turnover ratio is equal to cost of sale divided by closing stock. Cost of sales is equal to opening stock plus purchase minus closing stock is equal to 60,000 plus 1,90,000 minus 40,000 is equal to 2,10,000. Stock turnover ratio is equal to 2,10,000 divided by 40,000 is equal to 5.25 it times. You can solve it average stock also. 4. Debtors turnover ratio is equal to net annual credit sales divided by trade debtors is equal to 2,40,000 divided by 80,000 is equal to 3 times. 5. Creditors turnover ratio is equal to net annual credit purchase divided by trade creditors is equal to 1,60,000 divided by 40,000 plus 10,000 is equal to 3.2 times. 6. Gross profit ratio. Gross profit divided by net sales into 100 is equal to 90,000 divided by 3 lakh into 100 is equal to 30%. 7. Net profit ratio. Net profit divided by net sales into 100 is equal to 45,000 divided by 3 lakh into 100 is equal to 50%. 8. Fixed asset to net worth ratio. is equal to fixed asset divided by net worth. Net worth is equal to share capital plus reserve fund plus profit and loss account is equal to share capital 1,50,000 plus 30,000 plus 55,000 is equal to 2,35,000 net worth. Fixed asset to net worth ratio is equal to 85,000 divided by 2,35,000 is equal to 0.36. 9. Average collection period is equal to number of working days in a year divided by debtors turnover is equal to 365 days divided by 3 is equal to 122 days approximately. 10. Credit velocity average payment period is equal to number of working days in a year divided by creditors turnover is equal to 365 divided by 3.2 is equal to 114 days. Given below in the balance sheet of Viii and Company as on 31st March 2018. Earning per share capital 6% capital 1,50,000, 6% preference shares 75,000, general reserve 75,000, dividend equalization fund 25,000, 5% debentures 2 lakh, current liabilities 50,000, asset goodwill 50,000, land and building 1,50,000, machinery 1,75,000, inventory stock 1 lakh, sundry debtors 75,000, cash at bank 17,500, outstanding income 7,500, both of total, liabilities total 5,75,000, asset side total 5,75,000. Find out A. Solvency ratio, B. Proprietary ratio, C. Debt equity ratio, D. Fixed asset to shareholder fund ratio, E. Current asset to net worth ratio. Solution. A. Solvency ratio is equal to external liabilities divided by total asset into 100 is equal to 2 lakh plus 50,000 divided by 5 lakh 75,000 into 100 is equal to 43.48%. B. Proprietary ratio is equal to shareholder fund divided by total asset into 100 is equal to 3,25,000 into 100 is equal to 5,75,000 is equal to 56.52%. 3,25,000 into 100 divided by 5,75,000 is equal to 56.52%. C. Debt equity ratio is equal to debt divided by equity is equal to 2 lakh divided by 3,25,000 is equal to 0.61. D. Fixed asset to shareholder fund ratio is equal to net fixed asset divided by net worth is equal to 50,000 plus 1,50,000 plus 1,75,000 divided by 3,25,000 is equal to 3,75,000 divided by 3,25,000 is equal to 1.15 or 115%. E. Current asset to net worth ratio is equal to current asset divided by net worth into 100 is equal to 2 lakh divided by 3,25,000 into 100 divided by 61.54%. Hope you understood profitability ratio. Thanks for being with me during this session and hope that we will meet in the next session. See you. Thank you.